Hi, I'm Hansley from Livewire Markets and welcome to The Pitch. Our guest today is Jeremiah Lane, partner and portfolio manager for KKR's leveraged credit funds. Jeremiah, there is a lot going on in the credit markets, so why don't we start with the elephant in the room, what some people would say is the elephant in the room, and that's defaults. What are you seeing in terms of defaults and why does it matter for non-credit investors?
I think it's been interesting. I think a year ago, when I was on the road talking to investors, a lot of investors expected, that classic spike in defaults, spike in spreads, a lot of companies cycling together at one time. And our view is that people were right that a lot of sectors would cycle, but what people got wrong was that those cycles are happening asynchronously. They were happening out of time with each other in different sectors one at a time. And so if you go back to the end of 21, throughout 22, a lot of consumer businesses were struggling with a decline in that post-COVID demand. They were also struggling with the cost to import goods from China. That really squeezed profitability. That sector cycled and now has fully recovered. If you look at the last 5 or 6 quarters, you saw healthcare businesses in the US really struggle with the availability and cost of nurse labor. And they don't have any pricing power. They don't have the ability to change price mid-year. And so a lot of those businesses saw big declines in margin. And now there are some signs that that's abating. 2 sectors right now where we're seeing weakness are chemicals and packaging businesses. I don't think we found a bottom yet in those sectors. And then, looking forward, we think that there may be some weakness in home building over the next year. But all of that is to illustrate that we're not seeing that classic historical spike in defaults this cycle. We're seeing these companies in different sectors struggle at different times, and that's one of the reasons why we think the economy's been as resilient as it has been, that things have chugged along better than people expected. It's one of the reasons why last year ended up being such a strong year in the credit markets.
Okay, interesting. So I understand that KKR's base case for at least the US is no economic recession now, but do you have a sense, what do you think are the chances of a balance sheet recession, indeed maybe another SVB, another bank crisis occurring this year?
Sure, I think that the chance of that is really low. We do see problems in the banking system. We do think that several parts of the real estate market are really challenged. A lot of those loans sit on bank balance sheets. But one of the things that I've taken away from my time in the credit markets is, the next problem is never the same as the last problem. People were really fearful last year. First Republic failed, Silicon Valley Bank failed, Signature Bank failed. And, I think the government now appreciates the risk to the system and the risks that are embedded in banks and are taking appropriate steps to make sure that any problems that happen in an individual bank don't spiral out of control and cause systemic problems.
So this all comes back to, at the end of the day, this historic rate hiking cycle we've seen from central banks all around the world, the Fed, of course, leading that. How does this higher for longer narrative, that kind of a rate environment, impact where you're finding opportunities?
One of the big results of higher for longer is that, just the basic yields available in loans and bonds are much, much higher than they've been for a really long time. I think that you'd have to go back to before the financial crisis to be able to find this much yield in a portfolio of well-performing leveraged loans outside of a moment of stress. And so that's a really big change. There is a lot more return on offer right now than there has really been in a long, long time. And that means that we can do things a little bit differently. We don't have to take as much risk to deliver the same amount of return to our investors. We call that keeping it simple. It's easier to put together a portfolio that will deliver what we've promised investors than it has been for much of the 2010s for sure.
All right, some fascinating insights there. Jeremiah Lane, thank you for joining us there from KKR. And thank you for joining us for The Pitch. If you enjoyed the video, why don't you subscribe to the Livewire and Market Index websites as well as our YouTube channel. We'll see you next time. Thanks for watching.